Hello and welcome to this Cornerstone Finance Group podcast brought to you by Business News Wales. I'm Gemma Casey, editor of Business News Wales, and in this episode we're going to be looking at supporting clients with bad credit. Bad credit is often seen as a major barrier to home ownership, but with the right advice and market knowledge it doesn't have to be. With me to discuss this are Philip Keith, Director, Mortgage and Protection Advisor at Mellow Financial, and Vicki Picton, Director, Mortgage and Protection Advisor at Veritas Financial Group Limited. Hi both, thanks for joining me. Vicki, let's start with you then. So what do we mean by bad credit?
So bad credit or adverse credit would be when people have got missed payments, defaults, CCJs, or it could be that they've got a large amount of debt on their credit file.
And Phil, what can the impact be on somebody with bad credit when they come to you and they want to try to secure a mortgage?
So there's a number of things. So starting off with the amount of deposit they might need. If they've got particularly bad issues, then they may be needing certainly at least a 10% deposit, maybe higher, but also lender choice and product choice, because the high street lenders will be pretty sensitive to any credit issues that exist. But then having access to a wider range of lenders that will accept it, I suppose that's where we come into it, in finding the most suitable homes for these clients and navigating their world of limited choice and perhaps limited options.
And Phil, do you find that when a client does come to you with bad credit, are they generally aware that this is the situation and there's going to be an issue? Or is it something that you will sometimes uncover through those initial client conversations?
Yeah, so there's two schools of thought. Some of them come to us thinking, oh, I had a default 2 years ago, it's not going to be an issue. So they just bury their head in the sand. And then you've got ones that come to you thinking that it's absolutely impossible. So it's a case of exploring what the issues are and then helping them, educating them on what is possible and how something actually will still cause an impact. And on the flip of that, there are some things that they are totally fearful of that actually we can place. So it's a mix of both, really.
Thank you, Phil. Vicky, when you have somebody come to you, and as Phil says, they might know that there's an issue, or maybe they don't. But either way, if they know there's an issue, or then you uncover that there is one, how do you start off with that conversation with those clients? What's some of the best practice?
So I always suggest that first and foremost we get a credit check and then we can have a look over, because unfortunately a lot of people don't realise that they have some sort of blip, as I'd refer to it as a blip 9 times out of 10 on their credit file. So quite often we find this with communications, so your mobile phones, internet, water. If someone's moved house, they might not have known and not received that last bill. And it's not very nice for the client when they do come across that, and it really can panic somebody. So I quite often suggest that we do that before we even do the first fact find, because then we can uncover those straight away and start to have a look. I might be able to reassure somebody, because some people, like Phil said, will start to panic straight away that they've got something there. But it might be something that I know full well there's a lender that we can go to and have a sensible conversation with, and it will be fine with an explanation around it. And sometimes that's all we need, an explanation as to how that ended up. There are more and more lenders now in the market who will have a conversation with you as to a reasoning why, and as long as you can give them a good reason, they will take that human approach.
Jumping on the back of that, that's where I like sometimes working with some of the smaller building societies, so that we can actually have that
Yeah.
conversation with the underwriter in a common sense human transaction, rather than it just going through the computer and computer says no. So if we get adverse clients, it's almost like a good case, because we can pick up the phone, we can have those chats with the underwriters, and quite often than not, they're very empathetic. They will understand what they kind of do in their criteria, and even tell us, look, just get us this reasoning behind it, for example, and then we'll take it to the underwriting committee where more humans will look at it and give that really human touch. So it is good having that access out there, and the smaller lenders, absolutely. I do enjoy working with them. They are good.
Yeah, I'd say the same. I much prefer the building societies for that. I think before you jump to a specialist lender where it is all about adverse, quite often a building society will take a really good stance on it with that. And because we've built the relationships with those business development managers, They know what sort of clients you do, what in-depth work you do. And sometimes, because we have done that research, as long as a client is honest with us and we can get all of that information out of them, we can then go straight to the business development manager, have that conversation, and they start to realize that we do have these conversations. We are making sure that our clients aren't going to be put into a bad position by recommending this mortgage. So then that trust that's built between ourselves and the business development manager really helps us be able to go and have that fight our corner really for our clients.
And it really actually proves our worth and our value to the client when we go back to them saying, "Oh, I've got you a mortgage from XYZ Building Society," that they've never heard from in their life. And so I've done a research, I've spoken to them, and yeah, we can get it through because that's the great thing about a broker in these situations. We've got access to so many lenders that clients have never heard of. So coming to a broker, that's where you can really sell your service and skill set and knowledge that we know what we're doing. We've got access to these lenders. We've got many tools that we can check criteria and affordability and that kind of stuff, and then really get them the positive outlook. Making dreams come true is what we do.
That is a lovely way of looking at it, Phil. Vicky, you've mentioned, Phil has as well, the fact that clients in this situation will need to be able to explain why this blip, as you put it, has happened. What other practical steps can clients take, or would you advise them to take in preparing for these applications in terms of, for example, closing inactive accounts? Or are there any other things that clients can do that will really help?
Yeah, I think it depends how early they start planning. Because if they're planning to buy a property in, say, a year's time, or they know that the remortgage is coming up, I'd say have a conversation with an advisor quite early, because then we can have a look at your credit file early and we can probably give you some indication of things that are better to do. So, yes, going on the electoral roll, that would help as well. It doesn't work quickly, but of course, the sooner you go on the electoral roll, eventually that will start to have some sort of good impact. But yes, closing inactive counts, doing a credit check in advance so that we can have a look, know what we're dealing with. If a client's got a high amount of debt and they say I can pay something off, I would advise them not to just run off and pay things off, because quite often you'll find that a client might choose to pay off a loan because their credit card is interest free. However, that might stop the amount of affordability that they can take, because at the end of the day, a credit card is interest upon interest, whereas a loan does have an end date. Sometimes a client might think that they're being quite good and moving forward and themselves in a better position, but they don't necessarily know the way that a lender thinks. And of course, our jobs wouldn't be here if they did. So yeah, just closing things down really and talking to us as early as possible.
That's right. I say to a lot of my clients that time is a healer when it comes to things like credit reports, because things will work their way through a credit file. So if you're looking to buy in 2 or 3 years' time, it's going to be a very different picture to what it might be today. Vicky's dead right. And getting that early view, getting the planning done. Like Vicky says, if you can do anything about inactive accounts or big balances, then yeah, start working on it. Get that advice. And also, you might be able to do something there and then. People might not realize. So getting in touch with a broker thinking, oh, I've got 3 years before I can buy a house. And we go, actually, you can do it now if you really want. So it's just getting that early conversations. And I think that's regardless of adverse credit or anything, speak to a broker early and get your options assessed.
And Phil, what about protection advice? So this clearly goes hand in hand with giving somebody mortgage advice, but how important is it that mortgage advisors are ready to speak to clients with bad credit about protection considerations?
From my perspective, I don't let adverse credit really affect my protection advice because income is the backbone to all of this. If you don't have an income, you can't pay a mortgage, you can't get a mortgage. So as long as you've got the income, then we'll look to protect that. Of course, a lot of your income may be taken up in paying back some debts, but that's where things like income protection and different factors of that can help with that. It should the worst happen. So we're looking at protecting that income and making sure that the payments on the mortgage can still be met and then the lifestyle can still be maintained. Now, what levels of income protection do we go to? How long do you pay it out for? That kind of stuff comes into it. But it's a massively important piece that we are expected to speak to the clients about anyway. So I'm more looking just to protect their family as a whole, the adverse stuff won't affect it because in most cases the adverse is done and dusted. We're just dealing with it at this point and seeing it through. So the protection needs probably won't change. Say you've put them on a higher amount of income protection today because they're having to pay off some debts. In 5 years' time, they may well have paid down the debts, but then the salaries increased as well. So actually, that level is pretty maintained. So they're still going to be protected with the higher salary and not having to pay back the debts.
Thank you, Phil. Vicky, are there any examples you can share with us where you have successfully helped clients in this area?
Had quite a few clients who've had adverse credit. I had one come to me not too long ago, and they'd built up quite a lot of credit card debt and loans to the point where they were saying to me, we're struggling to manage now. They were managing to keep their bills on top of their bills and everything each month. They'd paid everything, and they hadn't actually got any adverse credit, but they had got a large amount of debt. And they knew that there was going to borderline adverse credit if we got to that point. So what we did do, we had a long conversation about it, because I wouldn't always jump to putting that on a mortgage, because of course you are elongating the amount of interest that you're paying over a longer period of time. Whereas if you can pay it on a loan or a credit card over a shorter period of time, you're paying less interest. So we discussed that through quite a lot. It wasn't really the case, and we did need to put that onto the mortgage. So we took that as a little bit of additional borrowing. We managed to find that all fine on affordability. It meant that the client was paying about £600 a month less out on debt. And then one Friday evening, I got a lovely photo from my clients. They were sat in the back garden with a glass of wine and credit cards cut up all over the table. And so it was quite a nice result, and they were clearly very happy. And even though they didn't have defaults or missed payments, it stopped that. I think prevention and speaking to somebody early, as we said before, is as much of it as anything else.
Those kind of testimonials and pictures are brilliant. So recently we've had a couple of Google reviews where they pretty much started the same, saying, I didn't think I'd ever get a mortgage, yet Mellow Financial's been able to do it for me. One of them, it was a lady who had 20 defaults on her credit file, all from different stages, different times, but been a bit of a rubbish relationship in the past, and then that split up, and defaults then occurred on the credit file. She thought she'd never buy a home on her own for her and her son. And we did it. And that's what I mentioned earlier, making dreams come true. That's what that kind of leads back to. When you get people saying, I never thought I'd get a mortgage, we were amazed. That's brilliant. And we did another one where they had defaults on the credit. Defaults are very common, I think, these days. I think through relationship breakdowns, also what we've been through in a financial crisis, then COVID, people leaving their jobs. There is a lot of it about. And it's almost, I wouldn't say it's become the norm, but I think we're seeing a lot more of it because of what we had. And it's good that we've got the lenders that can accommodate it, and brokers with knowledge and resources that can place this stuff. But yeah, when you make it happen for someone, it is very rewarding.
And I think if you do have to use, let's say, an adverse lender, there is a longer term plan as well. If moving them onto a high street lender in, say, 2 years, 5 years' time, and coming up with that long term plan with your client. Because I had one not too long ago, they just moved in. But I worked with those for well over a year, because unfortunately there'd been some fraudulent activity had been against them. Somebody had taken out quite a lot in their name, which they had no idea about. I found it, advised them where to go, who to speak to. Slowly things started getting taken off, into the point where they were like, we just want to move. So we did have to go with an adverse lender, which was very unfortunate, considering it wasn't something that they did to get themselves into that sort of position. However, we did manage to do that. And now in 2 years' time, we can move away from that adverse lender and move them onto a high street lender. So it's that sort of exit strategy as well, I would say.
Yeah, and it's that education to say that you've got adverse credit now, so yes, that will attract a higher rate, but you're not going to be on it forever. It's temporary. Pain is temporary. We'll get through it. And as you say, yeah, coming up with that strategy, maybe let's do a 2-year fix, let's do a 5-year fix, because then that gives time for that stuff to, say, work its way through the credit file. And so we're in a much better position when you come to remortgage. People, it surprises me the amount of people that don't realize that for themselves, that they're not going to be paying 5, 6, 7% forever. Who knows what's going to happen in the future? But if you take the here and now, they're not going to be with a specialist lender forever. We are going to move you to a better rate. It's our job to always look out for you and get you that better solution for you and your needs. Vicky's dead right. Having that conversation with them as well further proves our value.
I think the irony is as well, some of the adverse products that we're putting clients on at the moment, the rates are actually not all that different than high street rates were 2 years ago. It's maybe not as scary as what some clients think as well.
Yeah, very good point. Vicky, to stay with you, I'm interested in something Phil said a couple of minutes ago, where he mentioned that having bad credit is becoming more common. We've alluded there to tricky economic situation that the country has been in for quite some time, and also that people with bad credit are presenting to mortgage advisors that are far more often because of that. How important, Vicky, is it in your opinion that mortgage advisors are properly upskilled to be able to support clients with this?
Oh, really important, because the difference between whether you're going to jump straight to a specialist lender, which will be a higher rate, or go to a building society, which could be a middle rate, that could make all the difference. And sometimes the difference is that I've joined one of the networks, the weekly learning meetings that we have. So like a lender comes on, or making that meeting yourself. You might have one with the BDM and go and speak to them and talk to them about their criteria, and just getting your knowledge by speaking to either your peers, the network, who they put in front of you, or going and making those connections yourself can make all the difference between, it could be a full percent in what you're going to do, where you're going to place somebody. So I definitely say that it's worth keeping your knowledge as up to date as possible.
It could be the difference between being able to place it and not. If you view sort of adverse credit on a scale of 1 to 10, 10, you're never going to be able to place it. Someone's taken out an IVA yesterday. We're not going to do that. But if you attend these events, you get the knowledge, you know the criteria of these lenders, you'll probably be able to place 9 and below. So that's the value of having whole of market access. Whole of market is a loose term, maximum lender choice as possible. Having the knowledge, having the support, having the peer group where you can say, oh, I've got this issue, and then say, oh, I did it with XYZ lender. 9 times out of 10, you'll be able to place it, I think.
Final question to you both, because I'm conscious that we are nearly out of time, and that is, what would your one bit of advice be to a mortgage or protection advisor that might be listening to this, who perhaps hasn't had a lot of exposure to clients with bad credit and thinks that perhaps they do need to upskill in this area? Where would you advise that they start? Vicky, I'll come to you first.
I would say start by speaking to business development managers, have a chat with the building societies and a few of the specialist lenders, maybe speak to your peers about what sort of lenders have you been speaking to lately? Who have you been using first and foremost? Because you will probably find that there's the ones who, the everyday sort of adverse credit that you see, there's the ones that you'll go to first and foremost before you go to the ones that are even more specialist. I think speak to your peers probably help quite a lot.
Thank you, Vicky. And Phil, final word to you.
Yeah, so I break that down to 3: peers, network, and lenders. So be in a WhatsApp group where you can say, I've got this case, where do I put it? Network, attending events where, like Vicky says, when the lenders come in, they do the webinars, because quite often I've been surprised at some of the things they've said. Oh, we could do that. So, oh, I really didn't know that. And then lenders themselves, just looking at criteria. They publish it all, reading it, using software, which you can put in. I've got a client with a default 24 months ago, getting it all, reading it, because you'll soon pick it up and you'll have an inkling when you speak to a client, oh, that's going to go there. It's experience, it's tapping into all your sources of information. It sticks.
Great. A really strong point to leave it on. Thank you so much to my guests, to Vicky and to Phil, and thank you for listening to this episode of the Cornerstone Finance Group podcast.